says Hedgeye's macro psychoanalysis is great, but the Fed is not following the playbook. The P in the GIP is not on script for the past year plus. I completely disagree. We wouldn't be long bonds and bond proxies if we didn't think the Fed was going to be dovish. We certainly wouldn't have bought them in September, October of 18 if we thought they weren't going to eventually pivot. But I'll continue reading the question.
Sounds like the question's a little off script.
Yeah, well, it says the Fed's going to do whatever it takes to halt even a modest drop in risk assets. Fair enough, but just what kind of assets are you long is really the question.
But also, it's just back to the general point that lazy people make that get up at 9:25 and trade the market based on just knowing there's going to be liquidity. 100% of the liquidity comes after what? The market goes down. And 100% of those of you that owned it from that tangible top, if you want to go back to Q3 of 2018, before they came in and stocks effectively crashed within 3 months, then you wore that pain, okay? You knew about your liquidity. You knew the Fed was going to come in. But was it really a 1 to 2% correction? No, it was 20% in the S&P 500, 28% in the Russell Small Cap Index. So again, you know until you don't know. I understand and can empathize with all the shit you have to read every day because all they'll say is liquidity, liquidity, liquidity. But the reality is that risk management has nothing to do with liquidity. Liquidity comes after they have to manage the risk. So again, that's the point. That's the point. And we're going to stay with that. We've been right on point with that. And we have plenty of asset allocations that fit the ability to front run the Fed. Again, we've been saying this all along, that the Fed is going to have to get incrementally more dovish. And when they do, we get more aggressive on the gross long side.
Yeah, and if I can just... Let's talk about some liquidity, because H, you're dead wrong, by the way. Tweet at me, send me an email, whoever you are. I think your premise is dead wrong. So this is what I write down in my notebook.
Yeah, that looks like a lot of work.
Yeah, what's been going on, recently since a tangible top in the equity market? What's been going on since we call it the cycle turning in at the end of September 2018? So knowing about all your Fed liquidity, H, your beloved SPY, SPY, is up 14% since the cycle topped in rate of change terms in 9/27/18. But if you're long something like low beta, you've doubled that, up 28%. If you're long housing, you're up 38%. If you're long gold miners, up 52%. So again, it's not about being lazy and waking up 4.5 hours after Keith and I get up in the morning and saying there's liquidity, so buy SPY. It's about what the hell in the SPY are you going to be long and short. That's how you outperform.
Awesome. See that? I bet you he would beat you up on the beach too.
No, just with data.
I know.
Just with data. Well, appreciate it, H. It's a great teaching moment because, again, a lot of these people are very lazy and they wake up and be long SPY. Don't be the market. Beat the market.
That's actually American. That's the point of why Can't Hurt Me is resonating with Americans, because a lot of you become really lazy. Yeah. Not you. Of course, I'm not talking to you or to myself. In the accountability mirror, he calls it. We're all too lazy in certain points of our time. And a lot of you, if you've been watching TV or reading the Old Wall Journal, you're not just lazy. You're irrelevant. So that's the point. So let's get fired up in the morning to get it done. Let's do all the reps and not take lazy shortcuts and just come with these unanimous conclusions of liquidity. That would be a much better way to play the game over time.